Welcome to the 2024 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this first day of August 2024, ladies and gentlemen. We're heading into the late third quarter, early fourth quarter of this financial year, and things continue to go downhill as we head into this most important political season, most important economic season, social season, and spiritual season here as we try to wrap up 2024. Initial jobless claims rose more than expected last week, more than estimated. We have initial jobless claims, ladies and gentlemen, rising by 249,000 versus the previous week. Continuing jobless claims also rose nearly 1.88 million. So not only do we have initial jobless claims rising, but continuing jobless claims rising. Now, remember the good news that I told you earlier about a month and a half to 2 months ago was that continuing jobless claims were holding steady or falling. Now we have both initial jobless claims and continuing jobless claims rising at the same time. And this is according to FSstreet.com. This is according to the jobs report that came out at 8:30 a.m. Eastern time this morning on Thursday, August the 1st. So it says here, U.S. citizens that applied for unemployment insurance benefits increased by 249,000 for the week ending July 27th, this past week. This is according to the U.S. Department of Labor. So this comes above the initial consensus of 236K. So that's almost an 11,000, 12,000 difference there. And it's higher than the previous weekly gain of 235. Remember, these numbers get revised either upward or downward about 2 or 3 weeks after they come out to us. We get the statistics from the Department of Labor, the Bureau of Labor Statistics. So, but continuing jobless claims continue to rise. And this just means that the markets are going to be very volatile, even though that they are expecting a rate cut by the Federal Reserve Bank coming up in September, possibly. And at this point, ladies and gentlemen, you tell me, a 25 or 50 basis point cut when rates are above 5.25%, 5% the interest rates that the banks lend to each other and that they lend to us, auto, car, home loans, etc. Is that really going to make a big difference at this stage of the game? It would be better to not cut and then cut later when we need it than to cut now and do these little incremental cuts. It'd be better to just do one big cut of a full basis point or something like that instead of doing a 25 basis point incremental cut. But I digress. So the dollar index came under pressure and leaves earlier tops past $140 against the backdrop of the incessant move lower in the U.S. yields across the curve. So the yield curve is starting to invert. We have prices rising. We have jobless claims rising. The only thing that's not rising is mortgage rates right now. Mortgage rates fall slightly, according to FoxBusiness.com today, to its lowest level since February. So the average for the 30-year and the 15-year fixed mortgages declined to the lowest level in months. So we're down to 6.8% or 6.7? Yeah, 6.73% this week for a 30-year fixed mortgage there. So that's the good news. The good news is mortgage rates is coming down, but the not so good news, of course, ladies and gentlemen, is that prices for these homes value are double than what they should be in terms of the county tax appraisers and the municipality and all that. So the prices are still high. So theoretically, you could probably swing a mortgage for 30-year at a 6.7%, with good credit, great credit, and all that. But the problem is that you're paying almost double for the home what the house is worth. A house built in the 50s or 60s or 70s, and you're paying some of these states, like in California, you're paying $800K, $700K. You're paying $500K up in these places, in the Northeast, or $600K. So that's a lot of money, and it's still going to be the problem. So the prices are the problem. It's not so much the mortgage rate itself, as you can see in this chart. So mortgage rates can come down, but the price doesn't come down to match the salaries that are in the area, comparable, to match the comps in the area. Then you have a big problem. So Dow Jones, as you can see, was down 124 points. NASDAQ was down 100 points respectively, as well as S&P 500 down 1750. So what you can expect with this market is you can expect one day you go up 500 points, the next day it comes down 300 points. So you're going to see this up and down seesaw roller coaster as people begin to realize, shift around money either into more tangible assets like real estate or gold and silver, or in the companies that invest in food and tangible assets that people are going to be buying on a more discretionary basis. And you're going to be seeing that volatility past November elections here. You're going to be seeing a lot of for sale signs in a lot of these community subdivisions of people trying to sell and get into something to downsize, their lifestyle. And that's what we're going to be seeing here. And this is all part of the plan here. So, ladies and gentlemen, the slump continues on. Manufacturing contracts for the fourth month in a row. Remember, we don't manufacture anymore a lot of stuff here. A lot of stuff is shipped overseas. This has been going on since the 90s, late 80s, 90s. Manufacturing jobs, tech jobs, even some hospitality and tourism jobs have been shipped overseas. not beyond the call center jobs that we typically think of in places like Indonesia, Singapore, Thailand, etc. So manufacturing contracts are down for the fourth month in a row, and the ISM manufacturing index dropped to an 8-month low. So if we're not producing anything, even if we get into a situation where we go to a war, possibly, okay, some people will argue we're already in technically a kind of a Cold War situation, but if we get into an actual World War III, the manufacturing just doesn't ramp up as quick like it did back in the past when we were in our glory days, when the United States was in its glory days, from World War II, let's say from the 1950s to like almost the 1970, end of 1970s was like the booming years. It takes 10 years to bring that back, 10 to 15 years to bring that type of manufacturing factories back. Even if we're talking automation and technology and robots and all that, it still takes 10 years to develop that kind of manufacturing base. So we see that our contracts slump for the fourth month in a row, and we're not saying this. This is MarketWatch.com saying it. This is the ISM index. This is a key indicator, is that the U.S. factories are not producing this year. We're not producing a lot of things here, and so this can only mean one thing, is that we're heading toward some kind of slowdown, not a complete collapse, but a slowdown and a severe recession, kind of like a lost decade with Japan faced 10 years of non-growth or tepid growth. Let's say like below GDP, below 2% growth, and stagflation or hyperinflation. That would be the ultimate combination, along with jobless claims. If we get that along with this unemployment rate, right now the unemployment rate is at 4.1%. They say the official numbers. We know the unofficial is like 10%, but if it gets the real unemployment rate that they say in the news gets to, let's say 7 or 8%, then look out. All bets are off about and rate cuts wouldn't even help at that point, because you're cutting rates, but people don't have the discretionary income or have no income at all. And you notice that you see families living together in these subdivisions. You drive by any subdivision, you see 4 or 5 cars parked out in the driveways and in the landscape. I know you see it. I see it in a lot of these communities all across the country, and people are living together or renting out the extra rooms that they have in the house, subletting, Airbnb, whatever you want to call it. They're doing that because they need extra money, extra cash. And that's why people say, oh, cash is worthless, is losing value. No, cash is king right now, because even though the dollar is losing its purchasing power, still having cash on hand when they have these hacking situations where we had these systems down by, CrowdStrike or whatever it may be, you're going to want to have some cash at the house, or cash, elsewhere that you can access to not only pay bills, but just to live, the food, pay gas, get gas, conveniently, because people will still take that no matter what the value is, because it always will have some value. But like I said, like the U.S. government says, we can't guarantee the purchasing power. I mean, it may take more dollars to get the same goods, but we're used to that. We're used to seeing that because we've been living in this inflationary environment for the last 4 years, this hyperinflationary environment for the last 4 years since the pandemic in 2020. So this is what I want to encourage you to do today, is to continue to prepare. And the ways to do that is, like I said, is we're going to have to cut back our costs. We're going to have to cut down some of our debt, not all. I mean, we live in a debt-based economy, so I don't think that it's possible to go all the way, because you need credit cards for certain things like traveling and etc. Okay, but to cut back on certain things like that, cut back on eating out. Fast food has become way too expensive, so I only eat out like maybe once a week, if that. So I try to do once a week, and that's it. Just if I can, just start making meals at home, beans and rice, whatever. It's just better that way. So this is what we have going on now. The next big news we have to look forward to is coming toward the end of this month and toward September. September is very important because in September they're going to decide about not just a rate cut, but how much of a rate cut we get, number one, or if we're even going to get a rate cut, because Fed Chair Jerome Powell was very clear that he said that if the data shows that if things are not improving, meaning the inflation and this jobless claims, if we get 2 months of jobless claims rising like this here, then that means all bets are off for the rate cut, buddy. We're not going to get a rate cut if we're getting jobless claims rising, both continuing jobless claims and initial jobless claims, and that rises in August too as well, then I don't think we won't have a rate cut. So that is something to look out for. We're going to see how this market reacts to that. If they find out that in this month and this coming month here, and this is a long month, we have 31 days, so we'll see if the jobless claims rise and the continuous job rate cut, then all bets are off for rate cuts. And then we're going to see also what's going to happen with the manufacturing. Does it increase or does it not increase? So we'll see. But we'll keep you posted on that. So thank you very much, ladies and gentlemen. Please be sure to subscribe to this channel for 100% pure interpretation of financial news here. And I appreciate your support. I read all of your comments. Comment down below. What do you think? Do you think that what's going to break first? Is it going to be the unemployment rate rising, or is it going to be the or is it going to be the inflation continue to tick up and not go down to the 2% target rate that's going to cause the Fed to hold off on their rate cuts until after November? Let me know what you think in the comments below. Take care. Blessings. I'll talk to you very soon, ladies and gentlemen. Thank you for listening.